So here in this video, we have a ton of important topics to cover, one of which is what Tom Lee said today. It's about a 6-minute long interview on CNBC where he goes in depth on exactly why you want to be buying stocks right now. And I have to say, it's a pretty compelling argument. He speaks about inflation plummeting, the same in which Jerome Powell did just last week. If you also take a look at the technicals of the Russell 2000, the NASDAQ, and the S&P, it supports a continued rally coming. With that said, I would argue that most of you guys watching this video are all in Tesla, or you have a lot of your portfolio in Tesla. And I've been vocal on this before, but I want to be vocal on it at least one more time. We will discuss where I think Tesla stock is going in the near-term future. If you have not seen the last video, well, I said Tesla stock could go crazy this week. You started off this week with a 2% rally, and things look better by the day for Tesla as well. So we will discuss that. And the path of rate cuts coming could also be a huge beneficial positive for Tesla. So let's start off with Tom Lee. I'll provide some clarity and get into everything you need to know on all of these topics.
Yes, that feels investors are still too cautious, but he thinks that the fear of May or the sell in May and go away will turn into buy in May. Tom Lee is managing partner, head of research at Fundstrat Global Advisors, as well as a CNBC contributor. We'll never forget the call that you made, and it was one of many pretty good calls, but it was what the S&P was going to do near term based on inflation not being as bad as what was built into the market. And I think you're kind of returning to that theme. And I'd like to know why you think that. What do you know about inflation that the market doesn't seem to understand right now? You don't think we need to be as hawkish as we are?
Yes. A lot of it has to do with why CPI has remained stubbornly high. Powell talked about it, that there's this residual lag associated with housing. So even though home prices are stabilizing and rents are actually getting back to sort of traditional rates of growth, it's still reported in CPI at close to 6%. And then the second piece is auto insurance, is what Powell calls non-housing services. Auto insurance is rising at 21%. Now, a lot of that's because auto insurance rates are actually jumping, but that's not going to keep going 20% forever. Once that starts to normalize, then you can think about what median inflation is, which is running at 1.8%. So I think inflation's going to sort of cool pretty dramatically. I don't know when, but it'll be sometime in the second half of this year.
I think you, maybe a couple months ago, you weren't quite as bullish. I'm not sure what your reason, but you came on and said it might be tougher going. And we did have a series of inflation numbers that were hotter than people thought.
Yes.
Did we not?
We did. I mean, yes.
Yeah, and that you think that's not going to be the case as much from here?
That's right. I think going forward, a couple of things are better. One is like this job market isn't so red hot anymore. So I think the Fed's not on its heels as much about, inflation could fall. And then I think that the things I mentioned, housing and auto insurance, are going to start to cool. So inflation prints start to look better. And we know that we had a big reset in April. So I think it looks pretty good for now.
You must agree, I guess, that the Fed right now is in restrictive territory, because I've been amazed at how the default position for Jay Powell has been for weeks and months that we need to cut eventually. He never even, it seems like the idea of hiking has never even crossed his mind, and he took it off the table again last week, basically. But it's weird to me, with the economy as strong as it was and inflation as sticky as it was, I don't know why that was his default position. I don't know why he just wasn't more asymmetric or symmetric. I don't know why he just didn't say the risks were symmetric both ways. He seems so sure. He's jonesing to cut rates. He really wants to, and the market believes him. And every time he says it, the market rallies and gets ahead of itself.
Yes. I mean, my sort of guess is I don't think the Fed's that comfortable with long-term rates at these levels. It is quite high, and as you know, it's putting a lot of pressure on regional banking. It's really hurting their balance sheet. The cost of money is quite high, especially relative to the rest
And
of
you
the world.
think we are restrictive?
Yeah, I think it's quite restrictive, yeah.
You do. And you notice whenever we return to, okay, we're still doing cuts, and then Bitcoin goes. That's all it takes, right? The minute it looks like the printing presses are going back on, it goes. So you're still bullish. It's back to, I don't know, it was 50. I think it was at 57. It's back to 65 before you could blink.
That's right. I mean, Bitcoin's still, we think, early in an upcycle. So the idea that it could get to like 150,000 this year is still, within our base case. And
150,000 in 2024 is
Yeah.
your base case. Well, okay. All right, go on. I didn't.
Yeah. And
Go on. Go on.
Yeah, go on. Don't stop. Don't stop.
Yeah. I think it does help that the Fed is reiterating that its view on the inflation and it's being relatively dovish is more dovish than where the market is. So I think that's the process of why markets are recovering.
Because I know when they told me wrap it up and how that people always get mad on. You say you're going to come on Twitter and everybody gets excited, and then you're never on long enough for these people on Twitter. Should I pay attention to them?
Can I just ask one more?
Yeah, please.
And it has to do actually with what I saw when I was in Omaha this weekend with Becky. One of the things Warren did was he trims this Apple piece. And I think underneath a lot of the language that he spoke about for 5 hours, there was some anxiousness about the overall economy. You don't have that anxiousness. He's in there, has this massive portfolio, sees everything. What do you think of that?
I understand where he's coming from. I think if someone said, what are they anxious about, it is the fiscal deficit, the size of the deficit.
I'm not even sure he's anxious about that, though. I mean, he's anxious about the long term, but he was even asked about that, and that was not his issue. I think his issue was fundamentally, I don't want to put words in his mouth because he didn't say it. There's a lot of tea leaf reading, but just about the strength of where the market is right now and whether it's potentially overpriced.
Well, he's steering a huge ship. So, he has to think in, longer term. But to us, earnings growth is accelerating. Q1 earnings are up 7%, but, 3 groups are down 20%, energy, healthcare, materials. Those energy and healthcare flip to positive next quarter, so earnings growth hits 11%. We know there's a lot of pent-up demand. Capital spending is picking up, and the ISMs are turning up, and there's $6 trillion of cash on the sidelines, and people have been cautious for more than 2 years now. So I think the risk-reward's still pretty good. I don't know if maybe Warren's lens is more 10 years out, and that's when you can be cautious, but I think the next year looks good.
So I have to say off the bat, Tom Lee kind of makes the same reference that Jerome Powell made. Besides, Tom Lee is a little bit more blunt and open about it. Jerome Powell basically said the same thing, that he expects rent inflation will fall throughout this year, although the timing is going to take a while. And is uncertain, I should say. And when that happens, you're going to see inflation really come down in a big way throughout the second half of this year. And overall, during the last press conference from Jerome Powell, he was very dovish. He's been very dovish in 2024. And that is, as Tom Lee says, because the Fed is now managing the business cycle. And maybe the Fed sees something that we don't. That's my personal bit of speculation. But I think now that the Fed is your friend and they are managing the business cycle and they're not worried about inflation the way that they once were, I do think that makes sense to be bullish on stocks. I will tell you right now, you don't want to be bullish on stocks, or you want to be a little bit more defensive if we're actually going into recession, in which it's too soon to tell that. Maybe last month's non-farm payroll number just came in a little bit lower, 60,000 jobs lower than expected. Maybe next month is going to be an okay number. If next month you see another big drop, then you could be in for a little bit more of that recession fear narrative that comes into markets, which will definitely have a negative impact on stocks. But by then, if we get another bad non-farm payroll report, you're probably going to see the Fed cutting rates in the not so distant future afterwards. So it's a balance between How strong is the economy, or really how weak is the economy, and how much is the Fed going to be cutting rates? Investors will tell you, don't fight the Fed. And we were fighting the Fed if you were bullish in 2022, in 2023. And now you shouldn't be fighting the Fed. Now the Fed is bullish, especially as big tech earnings have now all came out. Besides Nvidia, they're going to be reporting a little bit later on. Even if Nvidia doesn't live up to investors' expectations, it's probably not going to miss. Like, a miss from Nvidia would be pretty unprecedented, and I don't think that's going to happen. As a result of these better than feared earnings from big tech, take a look at some of your technicals on the NASDAQ, for an example. I consider your 20-day, your 50-day, your 100-day, and your 200-day moving averages your important moving averages. People look at the 8-day, the 12-day, 21-day, 32-day, blah, 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 doesn't matter. You can pull up whatever number you want. But these are your important ones that a lot of algorithms trade off of. And you can see we were under this 100-day moving average back here on April 19th. You did see an 8.5% decline from the all-time highs on March 21st through April 29th. So almost a month, and the NASDAQ declined about 8.5%. Now, if earnings were to come in worse, then the markets would have fallen a lot more, in my personal opinion. But what you have seen ever since was you got above that 100-day moving average. You were bouncing between the 20-day here, this yellow line, and your orange line here, this 100-day moving average. You were bouncing in between that. What happened? On Friday, you were sitting close to your, or Thursday, you were sitting close to your 100-day moving average. You found support here. And then what happened? On Friday, you had a 2% positive day. You gapped up above your 20-day moving average. You found resistance at your 50-day moving average. Today was a 1.1% positive day for the NASDAQ. You gapped up above your 50-day moving average, and you closed towards the high of the day today. That's a pretty good sign. Markets at least have some momentum again to the upside. I also want to be pretty honest with you guys. I don't think there's a lot of upside left in the NASDAQ. I think the NASDAQ is expensive. It's priced for perfection. And sure, could you get back to all-time highs? Of course. But any large rally on top of all-time highs is pretty hard for me to fathom. Where I'm most bullish on is the small caps and your interest rate sensitive names. If you take a look at IWM and the same moving averages, 20, 50, 100, and 200-day moving averages, you're well above your 20-day moving average. You're above your 100-day moving average. You're above your 20-day moving average. Kind of like the same thing happened with the Russell, here IWM, as the NASDAQ. You were kind of hanging around your 100-day and your 20-day moving averages last week. And then on Friday, you gapped up about 1%, and you went all the way up to your 50-day moving average. You found support there on Friday, and today you're up another 1.3%. So you are definitely in some kind of breakout mode here. I don't know the trajectory necessarily if we just continue to rally from here and take a little bit of a breather, but you're definitely showing some upside momentum in small caps as well. Now, why I'm specifically bullish on small cap and interest rate sensitive names is because I do believe the labor market is going to get back to more of a pre-pandemic trend, if not get worse from here on paper. I think the labor market's probably a lot weaker than what the data actually suggests it is. After all, if you look at full-time jobs, you've actually lost full-time jobs in 2024. It's a lot of part-time jobs that are being added right now. So I think some of the data over the next couple of months could start to show that. And with that, I think inflation is probably going to moderate and start to fall again. And those are only my opinions, speculations. Again, a lot of that has to do with rents, and maybe rents start to get factored into the data a little bit more. But you do have 5 weeks, 1 day, 22 hours, and 36 minutes until the next Fed meeting. 5 weeks. So you're going to get a whole new round of data, whole new round of inflation data. Inflation data will come out a couple days before the June 12th next Fed meeting, probably June 10th, June 11th. You will get your inflation data, but you're going to get a whole skew of new data before then. And that may raise the odds of a cut in June, but I think it's actually July, because you're going to add another 6 weeks from June 12th through July 31st. So you're looking at here about 12 weeks before, or 3 months before, the July 31st Fed meeting. And I think by then, the Fed will probably either be forced to cut based on how the economy is doing, or likely have enough confidence, quote unquote confidence, to start cutting rates. We see that the Fed's already pretty dovish, at least Jerome Powell is. And I think by July 31st, you're going to be pricing in another cut, at least the first cut, July 31st. Currently, there's almost a 31% chance of your first cut July 31st and a 67% chance of a pause. So general consensus is no change will come on July 31st. But there's almost a 31% chance that a cut will come. And I think these odds are going to flip-flop. I think these odds over the next coming weeks are going to change to markets pricing in a cut and a low chance of a pause. Now, that directly kind of gets based off of what Treasury yields are doing. So that would imply 10-year Treasury yields probably continue to fall. Now, today they were down about 1.5 basis points, 10-year Treasury yield sitting at 4.487%. And if I'm expecting the first cut in July, one, the markets tend to price in things ahead of time. So that should be good news for small cap and for interest rate sensitive stocks. But that would, again, also imply 10-year Treasury yields falling. And that could create valuation support, that is, for a stock like Tesla, and at least stop some of the bleeding in your small cap and interest rate sensitive name. So in a nutshell, I believe we'll get a cut July 31st, September 18th, which is currently the first expected cut from the Fed, and likely December 18th. Now, if the data gets worse throughout, July and August and September, you could price in a cut for November as well. So I still think you're looking at 3 cuts this year. I think the Fed's still going to follow through with what their last dot plot said, which was 3 cuts. So I think the markets are actually more bearish than the Fed, and that's something else that Tom Lee mentioned in that clip. And usually the Fed kind of follows through with what they say. At least they try to. So that's what has been projected, and I think that could be an upside surprise to the markets. Now, this will obviously benefit Tesla. Just wait until you're getting close to actually seeing some rate cuts. The analysts are going to come out and have very rosy projections for Tesla's demand following those cuts, because about 80% of cars are financed. And right now, the financing costs are so expensive that as rates do go lower, and maybe 3-4 times this year, that's a lot more than what the markets are currently pricing in, only 2 cuts, then Wall Street's going to start looking at Tesla in a different way. Not just, we're waiting for the next gen models to come out, we're waiting for more improvements on FSD. It's going to be, hey, rates are falling here soon. Tesla's demand could start to really pick up. There could be an upgrading cycle, like the iPhone cycle of individuals that bought cars in 2019, 2020, 2021, 2022, 2023, that may want to upgrade to a newer Tesla, maybe the refreshed Model 3, maybe a Cybertruck, maybe a Model S or a Model X. And I think the perceived demand could get a lot better for Tesla as rates do start to fall. Now, I think the ultimate checkmate for the shorts that are short in Tesla, and I'll share those numbers with you in just a moment, is when the Fed really does start to cut rates. If they cut rates 3 or 4 times by the end of this year, and Tesla can actually start to raise prices and maintain those price increases, because as the Fed cuts rates, monthly payments will get cheaper to finance a car. Well, I don't think Tesla's going to give you all the benefit, as generous as Tesla tends to be sometimes. They're not going to give you all of the benefit of the Fed cutting rates. Tesla's going to try to get some of their margin back as well by raising prices as the Fed is cutting rates. Not on a 1-for-1 ratio, of course not, but some incremental price increases will probably be coming. I would be willing to bet a sizable amount of money on that. And I don't think that is something Wall Street is pricing in either. So this is one big reason why I think the next couple of months could be a fruitful time for Tesla. And again, going back to earnings, I don't want anyone to forget this. Something drastic has just changed with Tesla. We now have clarity. We have an Elon that is working for shareholders, not actively seemingly working against shareholders. You have an Elon that is seemingly all in on Tesla. Again, developing autonomous driving, full steam ahead, Optimus at the fastest pace possible. And Elon that really provided us a lot of clarity, saying, hey, we don't know exactly what demand's going to look like this year, but we're expecting a positive year-over-year delivery number. Meaning if you had 1.8 million deliveries last year, Elon's expecting something better than that this year. Wall Street was getting a little bit head over their heels, kind of fearful, if you will, that deliveries could come in really low, like 1.5 million, 1.5 million or so for this year. And there were some crazy numbers that started to come out. So we did get a lot of clarity on that front as well. And Elon Musk said they were not going to totally sacrifice margins, that they are focused on sustainable, profitable growth. And I think that really comforted the markets as well. Just as kind of an overall general statement, the last 4 quarters, besides the one we just got, were disasters. You walked away from those calls like, why am I even invested in Tesla? Who's running Tesla? What are margins going to be like? Robotaxi? Psh, that wasn't even a thought. In this conference call, you walked away from it with a lot of answered questions. Every question that was asked was pretty concisely answered. And I think that overall is a pretty big reason to buy the stock, especially if you sold the stock for any one of those reasons. So I think that also is working in the background and likely will for months as a positive for Tesla stock. If you look at Tesla on a technical basis, Tesla is above its 20-day moving average, its 50-day moving average, and it's not above its 100-day or its 200-day moving average. I think here in the next coming weeks, really this week, my expectation is Tesla could approach its 100-day moving average around 195, 196. I think you'll find some resistance there, but over the coming weeks, I think you do come up and retest that 200-day moving average around 220. And then ultimately, by the end of this year, you could be much higher than that. You could be into the high 200s, if not the 300s. So for everyone that asked, is now a good time to buy Tesla stock? I think right now is one of the last great buying opportunities for Tesla. And I think within 12 months, this time in 2025, Tesla could be close to, if not higher than all-time highs. Obviously, the next coming quarters of delivery numbers are going to be important, where margins go, what demand looks like, cuts from the Fed, the state of the economy, the next-gen vehicles. Do they come out this year? Do they come out first half of 2025? How does Cybertruck scaling go? Model 3 scaling? There's so many different variables here to that statement that I said of Tesla could make its all-time highs by a year from now. But even if I'm wrong, I don't think I'm too far off. Even if I'm wrong, I still think Tesla's well over $300 a year from now. And I do think in the near term, we could be looking at some pretty big gains as well into at least the low 200s until we get more clarity from the Fed or more economic data, more inflation data. The markets always are looking at the next thing. I also believe the short position is a big problem for the shorts. They bit off more than they can chew. Even today, continuing to short on net over 1 million more shares. They're in a bad situation. They need to see some bad news. The sentiment overall change for Tesla, and I don't think that's going to happen. So I think it's a matter of time before shorts get squeezed out of short positions. Now, if you take a look at the numbers here, the raw numbers, you have multi-year highs for the short interest at 3.85%. Of free float, $19.32 billion currently in short positions with 106.61 million shares that are currently sold short. it's just not a pretty picture if you are short in Tesla right now. And not to mention, the option activity in Tesla, including today over the past week, was 75% positive. You had almost 1,200 different trades from big money. These are only big money trades, not including retail investors, but only big money, totaling $364 million today, or this last week. That's a lot, and that's very bullish. Today, for May 10th, option expiration, you had volume to the call side of almost 61% and volume to the put side of about 39%. Almost 2 times as many calls today were being bought expiring this Friday than puts for Tesla. That's pretty dang strong. You did have Fed Williams today that says eventually there will be rate cuts, which again solidifies they're really not thinking about hiking rates anytime soon. The question is, when do they start cutting? You also have this post from Ryan Dietrich on X. He says the bull market is still quite young at less than 19 months old. Looking at the past 12 bull markets show the average is just over 60 months, but 5 out of the past 12 started in October like this one. When they start in October, they last even a little bit longer. And if you take a look at this chart that was put out by Carson Investment Research, the average return in this bull market is 155.9%. The median return is 101.5%. Those are big returns. The median bull market length is 60 months. The average is almost 65 months. So you could be very early cycle here in this bull market. But again, I want to caution you because I do think the NASDAQ, the S&P, they're pretty expensive. They're priced for perfection. Small caps, interest rate sensitive stocks are not. And I think when that does flip, maybe it's when we start to get the first cut, as long as the economy is doing fine. I think your interest rate sensitive stocks could see years worth of gains in just a couple of weeks as people pile back in. And you want to be positioned for that long before that moment happens. If I personally believe that moment could come in July, as I expect the first cut July 31st, which, I mean, markets could start expecting that in the next couple of weeks. I think you want to be positioned for that right now. But hey, what do I know? Let me know what you think down below in the comment section. Hit the like button as well as subscribe to the channel. If you guys want to come trade with us live in real time as well, check out that link down below in the description of this video. You guys have a great rest of your day, and I will see you in the next one.